Next, we will look at some of the practical issues and opportunities that StatArb traders face. StatArb is very competitive and it's hard for new entrants to compete in areas like index arbitrage, especially in major markets. Fortunately, there are lots of opportunities in smaller markets and less liquid stocks and other assets. These markets are less efficient and so they offer more opportunities to trade profitably, but on a smaller scale. StatArb profits are eaten away by a range of costs, including trading, clearing, and exchange fees. These are especially heavy for high-frequency traders. There are also risk-based charges which factor in the cost of trading capital being tied up in collateral and margin for derivatives positions and short sales. Added to this are the costs to borrow assets for short sales, especially when there's a very high demand and limited supply, as is the case when several hedge funds decide to short the same stock of a closely held company. Think Beyond Meat or Lyft. This is referred to as the asset being on special, where the stock lender charges you as much as 60% to borrow the stock. This means you put up collateral of $100 and receive $40 back at the end of the year. Obviously, this is not a good strategy for more than a few weeks. Lastly, there's a market impact cost of trading. Lower frequency arb traders usually sell at the bid price and they buy at the ask price. And so they lose about half of that bid-ask spread on each transaction. This is paying for liquidity or being a liquidity taker rather than a liquidity provider, such as a market-making firm. Arb trading firms consume lots of data. Initially, a firm must purchase and cleanse historical data that it will use as the input to models and strategies. Market feeds vary in price depending on the level of detail needed by the firm. Daily open, high, low, and close data is essentially free. High-frequency data is more costly, but is essential for most quantitative strategies. High-frequency traders also need to have full visibility into each asset's order book and tick-by-tick data on the timing and size of transactions. This type of feed can be quite expensive, especially if a firm trades in several markets at the same time. Remember my earlier observation that the most promising areas for traders were smaller, less liquid stocks and markets? This comes with a big caveat. In order to profit from these stocks, you need to actually be able to trade them. The reality is that liquidity is heavily concentrated in the largest cap stocks in the largest markets. This is part of why these markets offer fewer mispricings and other inefficiencies. When you design a trading strategy, you need to take into account how much trading actually takes place in the stock and what size of bid-ask spreads you will face if you decide to transact. These hurdles can make an otherwise profitable strategy either unexecutable or unprofitable. Another challenge is that it's sometimes hard to borrow certain stocks. Recall our discussion of stocks being on special. In this case, you may not be able to find a stock lender when you want to short them. Also, trading in a stock may be halted due to pending news or simply because the market is not open. This can cause you to lose a lot of potential profit from a strategy. In our earlier example of spread trading a pair of stocks, we had to wait a long time before the spread reached a level where we could sell it, and then another long time before it reached a level where we could buy it back again. During these waiting periods, correlations can change dramatically due to new information or events in the market. The longer your time frame, the more sensitive your trade is to these risks. This type of risk is generally not an issue for high-frequency traders who focus on ultra-short time frames. Instead, they have to worry about covering high trading costs with frequent but usually small profits. One of the most important things you need to keep in mind as you develop strategies is that when you trade a correlation or spread, you can also change the market you're trading in. Prices will change immediately, and other traders may withdraw liquidity if they sense a spread is being traded more heavily in one direction. They may also be able to figure out that your strategy, even if your trades are anonymous, by noticing changes in price patterns and asymmetries in the order book. Ultimately, if your trades are large enough or persistent enough, they will eventually eliminate the profitability of the correlation or inefficiency. This is especially true when other firms start trading the same strategy.